All right, it's been a while, but it has happened again since the first time since the financial meltdown. U.S. regulators have shut down a major U.S. bank, the 16th largest. It's called Silicon Valley Bank. They've taken control of customer deposits in the largest such failure, as I said, going back to the meltdown that year. This comes as a firm which is a key lender, technology companies and venture capital firms, or venture capital funded firms, I should say, was trying to raise money to plug a loss from sales due to higher interest rates. It has a lot of Treasury notes and bonds on its books. More than half of its better than $200 billion are Treasury notes and bonds. The irony there is those are conservative investments and as safe as you can be. But for a company like this, leveraged to the point that it needed cash fast, to cash out of those, it would be underwater. And, well, obviously, you know what cascaded since. Federal regulators have said, and Janet Yellen, the Treasury Secretary, has emphasized that this is not widespread, that they're monitoring the situation, and the FDIC will back depositors there. We have Gary Kalpon with us right now on the significance of what's going down. And from what we hear, Gary, only this institution going down. We also have with us, as you can see there, Douglas Holtz-Eakin, the former CBO director, and Susan Lee. So, Gary, on that notion, this is isolated to this bank. What do you think?
Well, they tell us it's isolated, but just remember, they've also told us everything's fine and there are no problems out there, yet the 16th largest bank is now being taken over. And I always worry about the word termites. Is there anything else out there? Just remember, banks are as good as the deposits that are with them. When there's a loss of confidence in those deposits, you end up like this. So cautionary tale. The worry is, and I've stated this to you before, Neil, every asset price, every economic statistic and data point and decision by businesses, big, small, has been based off of that 0% interest rate and the printing of $9 trillion. And now we've gone pretty much to another extreme. And now we got to get used to that. And I think the good news coming out of this, every bank, big or small now, is going to be meeting this weekend to make sure capital is shored up and they got things in order. And that's about the only good news, because there's nothing but bad news with Silicon Valley Bank.
All right. Doug, I do want to go to you, but just to give you an update, Doug, the former CBO director, by the way, at the Federal Deposit Insurance Corporation, FDIC as it's known, protects people's deposits, and they are protected up to $250,000, has taken charge of these deposits and promised that protection. Clients with these insured deposits will have access to the funds, we're told, by Monday morning, Doug. So they're obviously sending a signal. Right. No bank run is necessary. You don't have to rush to the bank. Good luck trying to withdraw funds anyway at this particular juncture. But that is very different than the environment we had back around 2008, when it was like, you know, a free fall when people were losing their heads, right? Very different.
Yes, so this is very different. I mean, if you recall, I did spend some time on the Financial Crisis Inquiry Commission, and this doesn't look like 2008 at all. In 2008, we had global problems. Some of the first failures were overseas, in fact, and we had this problem of having this mortgage risk on every balance sheet in a not particularly transparent way, heavy reliance on derivatives, hugely levered financial system and borrowers. This looks like a business model failure. The Silicon Valley Bank had poor management of its Tier 1 capital, heavily concentrated in one asset, and it had a very narrow client base. It's all tech companies, and so it's literally just Silicon Valley. And so I think of this as a real management failure, but I don't think it's a financial system failure.
That's a very interesting read. You know, it's interesting, Susan Lee, I'm reading a report from the BBC reporting on this, that while the bank is a crucial lender to early stage technology businesses, those that sometimes can have difficulty finding financial backing, you know, except through venture capitalists and those who, you know, billionaires who want to take a risk on an investment, that there does not appear to be any widespread venture capital fallout here. What do you make of that?
Yeah, so I've been trying to call around Silicon Valley and venture capital firms right now. I can tell you that some of the blowback has to do with communication, and especially from the CEO of Silicon Valley Bank, Greg Becker, yesterday on that call with investors and staff saying, stay calm. staying calm when your stock is down 60%. Some said that wasn't enough. He should have gotten out there, been more forceful with some of these startups and also some of these venture capital funds, because a lot of people said this is the FDIC stepping in here. The fact that yesterday we were talking about $200 billion in assets to cover $175 billion in deposits. The money should have been there to cover some of those liabilities. And the fact that right now you have the regulator stepping in, this is a failure of management, risk management, possibly by Greg Becker, but obviously a breakdown in communication and how he was talking to some of those VC funds out there.
Gary Kaltbaum, it's interesting, speaking in Washington, that Janet Yellen had said she was monitoring, continues to monitor these developments, that they're localized here. She said, looking at a couple of other banks, I don't know what couple of other banks that meant or what she was implying. But again and again, saying we are monitoring things very carefully, quoting here, when banks experience financial losses, it is and it should be a matter of concern. It's just interesting that someone of her, influential heft, she is the Treasury Secretary of the United States, it is a concern. So I guess that's my way of saying I don't want to minimize this either when you have an institution of this caliber going down. And by the way, not going down with shaky products or derivatives products. I mean, its bane of existence, ironically, was investing in something that is considered the safest on earth, Treasury notes and bonds. I digress. But saying that its situation is a matter of concern. What do you make of that?
Well, look, you just got to, the banks are the pipes of the financial system. Money flows in and out. And Janet Yellen has to make sure there isn't anything else out there. And I can tell you the best way to know if there's something else out there, just watch stock prices. Silicon Valley Bank's stock price determined what was going to happen. They tried to do an offering, and as the stock cratered, they could not get the offering done. That was the market yelling and screaming something was really wrong. So I think I saw a couple other stocks cratering today, and they came out with news. Wait a minute, hold on, we're nothing like this. I think there's probably going to be a few more of these before we get away from this. And look, you just got to keep fingers crossed. Back in 2008, it started with one, and then the next and the next. You just don't want to see that. Just remember, we have a lot more, much more debt than we had back then, and you just don't know what's underneath the surface. We didn't know about the alphabet soup back in 2008 or the CMOs and CDOs and MOUSEs, so we really don't know how much derivatives there are, and that's what I think they're going to be addressing and really looking over big time over the next week or so.
Yeah, certainly going into this weekend. So, I will sort of ask you, Doug, about, and you've all touched on it in different ways, the so-called confidence people have in the system. And it's interesting that all the major regulators came out to say, your money is protected up to $250,000. FDIC is on the case. Don't withdraw money. Don't run to an ATM machine. They're not saying that, but again, quick assurances to prevent anything crazy from happening. And looking at the Dow and some of the other averages, even the NASDAQ, very much at the mercy of higher interest rates. Just the opposite today. Those rates are coming down. This has a lot to do with it. So I'm just wondering, hearkening back to your memories of the financial meltdown, Douglas, and that's a big difference here. And I'm just wondering whether rallying people to get their confidence back so they don't freak out, is it working as far as you can see?
The regulators are running the playbook, which is to remind people of the guarantees, to point to strength elsewhere in the financial system, to remind people that it's better capitalized, to point out that this has been extremely localized in nature. And so that doesn't happen overnight, but I think they're doing what you would expect them to do. I want to go back to something Gary said, because I think it's spot on. What gives you financial crisis-like conditions is to have some systemic common weakness. And, in the credit bubble that was leading up to the 2008 crisis, all the banks shared that, and then they layered it on in a highly leveraged and derivative-driven fashion. What's common here is people used to having zero interest rates and easy money, and it's gone. And There are people who are going to manage that well,
point.
and there are people who are not.
That is the seed of everything. You just mentioned the most basic point of all. We got spoiled, a decade of at or near 0% rates, and Susan Lee, the reality of that is hitting people. I mean, I found the Wall Street Journal take on this interesting, quoting here. Once a darling of the banking business, Silicon Valley Bank collapsed at warp speed after it announced a big loss on its bond holdings. And here's an interesting addition to that, Susan.
Yeah.
And its plans to shore up its balance sheet, tanking its stock and sparking widespread customer withdrawals on the notion that rates that were so low were no longer low and aren't going to be for a while. What do you think?
I also find it astronomical that you have a bank that had $200 billion in assets. They couldn't raise $2 billion. What does that tell you about this type of funding environment when rates are close to 4 to 5%, and you're so used to 0% for the last 15 years? But there is concern now about the regional banks, the smaller banks, maybe not the JP Morgans and the Goldman Sachs. But I'll tell you that Bloomberg just came out with this write-up saying that a TD possibly purchased bank in Memphis, Tennessee called First Horizon is down about 6% because of their concerns over capital controls there. And we know about the concerns over First Republic. So maybe the major lenders, there might not be a contagion effect, but the smaller layer, I think there is some rethink on Wall Street about how well capitalized they are, how insulated they might be from Silicon Valley Bank or even from Silvergate.
Yeah, you're right about that. Guys, thank you. Please stick around. We're going to have a little bit more.